Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in Landon Swan. He's a co-founder at LikeFolio. Welcome back to the show, Landon.
Thank you, Tom. Good to be here.
All right. We're talking retail. We're talking Dollar Tree. The last couple earnings, this stock's been whacked and down about 17% so far this year. It seems like in this type of inflationary environment where people are trading down, that Dollar Tree and maybe discount retailers like this would do really well. Is it just that the consumer is pushing away from any items that they might sell, or is it a margin story?
Yeah, I think it's more about margins. I mean, in their last report, they talked about having an 8.2% increase in sales and a 43% decrease in profits. So that's tough. It's tough to sustain profits there, and I think that's what investors are concerned with. They've got rising operational costs, and as you mentioned, all of that concluded with them getting hit for the second time in a row on earnings. Now, they have bounced back a little bit, coming up on some potential resistance or a recent top, I guess, if you will, around that 117. That's kind of where we're hovering right now, is right around that 117. But you can see this used to be a $150 stock not that long ago. So, they have absolutely been crushed, even though they've beat expectations. But, that's like a 12 handicap shooting 75 several times in a row. You kind of figure out what's going on. So, when we look at the data, Dollar Tree is actually looking pretty solid. Their mentions on a year-over-year basis for the Dollar Tree brand are up 46%. For the Family Dollar, they're about flat on a year-over-year basis. So Dollar Tree definitely carrying the bigger load here. Family Dollar lagging a little bit, their other brand. And now Family Dollar did just do a mobile app refresh, so hopefully that will lead to some increased sales. But you can see we've got, what we would call a divergence. I mean, the mentions are sustaining. They're up on a year-over-year basis, holding pretty strong, company-wide up about 34% when you combine the brands. Also, Happiness is doing really well. It's up about 8% on a year-over-year basis. So they're beating Dollar General by about 7 points, but they're lagging behind Five Below significantly, 13 points behind Five Below. So they're doing well on Happiness, up on a year-over-year basis, passing Dollar General, but a long way to go before they get to their competitor Five Below, which, as you know, we've always been pretty bullish on them. Their data always comes in very strong. Of the three, that seems to be the winner for us on the data side. But focusing on Dollar Tree today, I will tell you that everything with the data, if you consider what's happened with the stock, it's got us just barely leaning bullish. Basically, this is a low bar play. We believe that the data supports very low expectations being met or beaten here. So if this was trading at $155, $160, we would not be all over it. We'd be neutral. Heck, we might even be bearish. But at 117, I think that there's room to kind of fill the gaps that have been formed by some of these last two earnings reports and maybe work their way back up to the 120s and 130s on a decent report. We're not expecting anything amazing, but we do expect a decent report out of this one.
Yeah, Landon, just like Target, you don't need anything amazing for the stock to recover. The bottom line here for this company is, and this is another economics theory, consumer staples, or they trade at lower margins than consumer discretionaries. And when this world that we live in switched and the economy shifted towards essentials or staples, that hurt their margins. Throw in a little theft, throw in a little shrinkage because of that, and these massive companies that go on such tight margins, a little bit of tweak in those affects these significantly. And you're right, Landon, after two earnings misses in a row where the stock has just cratered both times, maybe the bar is really low here for them to get over and have this stock recover slightly.
Absolutely. This is kind of a target play, like you talked about. The stock has sold off significantly, but again, they met expectations, on these last two reports, but the market wasn't having it. So they sold off. It wasn't strong enough, even though the sales were up, profits were down. That's always a concern when you start asking questions of like, okay, your sales are up while your profits down, and those answers are always unfavorable to hear from investors. Now for investors, and I will tell you though that this is the time to be discount selling. I mean, there's a report out by PwC that 75% of consumers are actively looking for discounts this holiday season. So, I mean, you know, many consumers have tight wallets right now, and a company like Dollar Tree, Family Dollar can take advantage of that, so that they're in a good spot if they can get rid of some of those other challenges like you talked about, rising costs, and of course all the theft that's going around. So again, this is not LikeFolio saying Dollar Tree is about to come out and just crush expectations and it's going to trade up 20-30% tomorrow. But I do think that with expectations as low as they are, I mean, that's basic technical analysis. That, you know, when people sell, they sell because they have lower expectations. When they sell, the price goes down. That's why we're at 117 instead of 150 or 160. So I think that those low expectations can be met or beaten on this earnings report.
Yeah, and that's kind of what I was going to hit on, because you mentioned Target, both of you guys, the low bar that Target had going into that report. The caveat for me, though, Landon, is, you know, you mentioned the shrink. I don't think they're getting rid of that problem anytime soon. The margin pressure, the product mix was wrong. Inventory levels a little bit, you know, missed there. It took Target 7 quarters to recover from their initial fall, based on a lot of the same type of ideas that, hey, they didn't do well on inventories. Their shrink was growing. They seem to have the same problems, and it took over a year and a half on this one. That's what kind of scares me, is the outlier here for this type of company. Do you guys see, you know, that this is retail's a harder one to kind of turn around?
You know, you've got a point there, and I'll tell you what, it could be the case where, you know, they continue to slightly disappoint. I would be surprised, though, if they have a reaction as negative as the last two. So, you know, being a betting man, if I've got to pick one side or the other, I think up is a better pick here, because if they do turn it around, the expectations are so low. And if they don't turn it around, again, the expectations are so low that maybe they don't sell off that much. So I like the edge here. It's a small edge. Our earnings score is plus 23, and you guys know that 20 is our limit. So this is barely a bullish bet for us, but I think it's worth a bet.
Yeah, bar is low on this one, and a lot of the data that we're seeing out of retail sales, and especially some of these cyber numbers and stuff like that. So the consumer's still out there spending. All right, great stuff, great data as always, Landon. Appreciate it.
Thanks, guys.
All right, that's Landon Swan, co-founder at LikeFolio, bringing us the data on that. Pretty positive on this one, but it's not surprising to see that. And you would think, just like I mentioned earlier, if they didn't have those higher costs and some of the theft and stuff, they had a couple good reports